I'm Ivan Illan, founder and chief investment officer for Aligne Wealth Advisors Investment Management. Even though labor force participation has increased, and we think that will be a very positive thing for the Federal Reserve and their decision making on rate hike increases over the next couple of months, we don't think it is a silver bullet that's going to solve all of the economic issues that we're forecasting. We are taking advantage of higher short-term Treasury rates. We did initiate a position in a very short-term Treasury with some very short-term corporate, U.S. corporate allocations. And that was the first time that we've deviated from our ultra short-term bond allocation, which we've maintained a pretty significant weighting towards over the past couple of years. So now we're beginning to wade into a little bit longer dated, but still very much on the short end of the yield curve, as certainly the short-term yields are just quite attractive. We do think that we have seen the peak of inflation, and as a result, we have also liquidated fully our exposure to Treasury inflation-protected securities, also known as TIPS. During the month of August, we did sell the remaining allocation that we had in the S&P 500 market weight index. We still own the equal weight indexes, and we do like having those, and we'll continue to hold those for the time being. But the market cap weighted index for the S&P 500, we've decided has seen better days, and as we look forward, we're not interested in having those leadership stocks. About 30% of the market cap weighted S&P 500 is in just a few stocks. The top 10 actually represent 30% of the entire weighting of the S&P 500. This to us is still way too much concentration risk, and we prefer to have a much more egalitarian exposure within US stocks. We are considering a few things that may be of interest to you. The first is that we are thinking about reducing our European financial exposure. The reason why we initiated that position was because we wanted to get some great yield, and we did buy into that position where we were essentially earning about a 6% dividend annually. So that position has really served its purpose from our standpoint. And now that interest rates are beginning to look much more attractive and fixed income in general is starting to look more attractive, we can really abandon the types of dependencies that we had on cash flow into these portfolios. And so that is something under consideration, though we haven't pulled the trigger on that at this point and don't have a time frame for doing so. We're very interested in buying into intermediate term investment grade US corporate bonds. At this point, the yields are just not quite there yet. We think we'll get an opportunity perhaps before the end of the year. Something that may surprise some of you is we actually are considering taking a position in gold. And certainly if you've heard me speak on this topic in the past, gold is something that we just generally don't believe is a great thing to invest in unless you're going to wear it or you're going to have coins associated with it. To buy an inert metal is really kind of just basically calling it quits on stocks or any other kind of equity. And we're not really there at this point. And also gold hasn't been behaving the way that we really like to see it behave, which is more of an inverse correlation when the stock market takes a big dive. And it hasn't been holding up in that way. And at the same time, there is something interesting about it. It's certainly holding its value a bit better than the broader stock market. But again, that's just not enough to warrant taking a position in gold. But it is on our radar. Thank you for joining me to get this update on what we've been up to in our portfolio strategies. And please, if you have any questions at all, don't hesitate to reach out.